Thanks for tuning into the All Funds Network. My name is Mike Schroeder. Today I'm here with my co-host Skyler Steinke, as well as Brook Scardina, managing partner of Oak Real Estate Partners. Brook, it's great to have you on the show.
Thank you, Mike. I appreciate the opportunity to share the time together today.
Absolutely. Well, let's kick it off with your background. Oak Real Estate Partners. Tell us about what you did prior to Oak Real Estate and kind of opportunities you guys saw, kind of how you got into business.
Yeah, so I principally spent most of my career at UPS helping to manage the pension and retirement plan. I did that for several years. When it kind of started, it's kind of a unique story is because there were only 6 of us in the investment office, but yet we had responsibility for overseeing and managing 15 billion in AUM. But it really afforded me a kind of a really unique opportunity being involved in all facets of portfolio management, everything from sourcing to underwriting to, portfolio modeling. I don't know that I could have gotten that transactional experience, by virtue of working anywhere else. So it was a great platform, great team. I was recruited then over to UNC Management Company. UNC Management Company was a privately held company that was commissioned to manage the endowment dollars for the University of North Carolina at Chapel Hill and most of the North Carolina system affiliated schools. We ran it as an open-ended commingled vehicle. We had about $8 billion in assets under management. Just spent a lot of time in educating the other universities about our strategy, investment philosophy, risk management, et cetera. I came back to Atlanta. I had the opportunity to help join the Georgia Tech Foundation to help them institutionalize and optimize their investment program. Then I got connected with the folks at Oak Real Estate Partners, and having always served as a kind of on the LP side of the business or the institutional allocator side of the business, I saw what we were doing in kind of the private credit space and certainly wanted to be a part of the journey. It's a pretty unique time to be in private credit right now, and we'll kind of delve into the details of that as we kind of get it further down into the podcast. But, at a 30,000 foot view, that's kind of the background.
That's great. Very cool. Well, maybe just kind of starting out talking about kind of as you started at the firm, kind of what you saw as a trend in the space and maybe get into specifically what you guys do at the firm at a high level, and then we'll get into specifics.
Well, I think, before we kind of delve into kind of private credit as an asset class, and my intention with this is to be very informational, right? I want to share the market intelligence of what we're seeing and experiencing. But I think before you talk about private credit, as kind of a strategic asset allocation, I think you have to put it in the context of the broader financial market, right? And we've seen a significant amount of volatility across traditional asset classes this year. And, we've seen kind of a re-risking within the equity environment. And now when you look at PE multiples and valuation levels, they're kind of trading in the top decile, right? So PE valuations are well above historical norms. So why is that important? Well, I think that increasingly introduces some downside risk, given where PE multiples are. And when they're trading in the top decile, if you look at 10-year forward-looking returns, they've generally been in the low single digits. Now, markets, it's the old adage, markets may not repeat, but they often do rhyme. And so I think you have to look at it in the context of kind of where we are in the market. And look, I think everybody's quick to acknowledge there's a significant amount of uncertainty embedded in the markets right now. You got a tremendous amount of geopolitical risk. We got the Fed meeting tomorrow, the path and the trajectory of inflation and the impact of that on global growth. There's a lot of things that investors are naturally having to contend with. And so then if you kind of flip over to the fixed income side of the market, I think you're seeing, equity-like volatility in the treasury market. And it's interesting is we ran an analysis for a fairly large, endowment, and they have a fairly significant amount of treasury exposure. And what the analysis revealed was pretty amazing, actually. From 2022 through June 6th of 2025, the 10-year treasury had moved plus or minus 10 basis points, 119 trading days. So those are 1 to 2 standard deviation moves in an asset class that tends to be a flight to safety. It's supposed to be one of the most liquid asset classes. And so you're getting a tremendous amount of volatility out of the treasury market right now. So as investors think about, kind of a 60-40, a traditional 60-40, 70-30 asset allocation mix and portfolio, exposure to alternatives and private credit can be instrumental in so many different ways. But I think if you were to really decompose it at its core, and we'll talk about private credit here in a second, but alternatives, even specifically private credit, right? The 3 ways that it can contribute is, number one, it can help enhance the diversification within the portfolio. Because if you look at the return streams, they're truly uncorrelated to broader financial markets. It provides and delivers a differentiated source of return, which can be extremely accretive to contributing to a portfolio. Secondly, is it helps improve the risk efficiency within the construct of a portfolio. And so we position our strategy as a more optimal alternative to traditional fixed income because number one, you don't have the duration and the interest rate sensitivity, but you also don't get the mark-to-market volatility that you otherwise experience in the public debt markets, right? So there's a tremendous amount of advantages there. And I think the third part is that, it can be really instrumental in the sense that it can contribute to the optimization of a portfolio. And what do I mean by that? Well, if you look at the empirical evidence, private credit as an asset class has typically generated 300 to 500 basis points of incremental yield and premium in relation to the public market equivalent. And so, you take those three things in combination and it can be, extremely advantageous, if you incorporate it as a part of a total portfolio construct. So now more specifically to kind of what we're seeing. So we operate in a very unique or specialized sector of the market. And as a firm, what we're able to take advantage of are the structural inefficiencies that exist in the lower lending private credit sector, right? These are transitional bridge lending opportunities that are short in duration, they're senior secured, and they're fully collateralized by high quality income producing commercial real estate assets. So what do we define as lower lending? Well, we define that as $2 to $20 million. Now, what I can tell you and the benefit of the audience is that sector of the market is extremely inefficient, it's highly fragmented, and it's completely underserved. I think one of the benefits or advantages is we are not competing with the likes of Blackstone, KKR, and Apollo. They're just not playing in this space, but there's 200 to 300 basis points of incremental yield that you can extract by virtue of the lack of national competition in this space. And so part of our investment thesis is really predicated on the fact that banking regulations, legislative changes, capital reserve requirements have all created a very restrictive environment for banks. And absent there being broad sweeping banking relief, which would be unprecedented, by the way, we don't expect this market environment to change. We think the opportunities within private credit on both an absolute and relative basis are going to continue to persist. And so that's what we kind of are in the business of taking advantage of for the benefit of our investors. Now, one of the things that I'll tell you is that, you can't turn on Bloomberg right now and not hear something about artificial intelligence in private credit. And so part of what we take the time to try to educate people into is that not all private credit is created the same, right? There's private credit on companies, there's private credit on venture, there's mezzanine debt, subordinated debt. The benefit and advantage of being senior secured is that you're in the first lien position, right? You have first priority to the asset. And that gives us, a lot of comfort, and that it really serves as kind of a very significant risk mitigation because our goal is not to take acquisition of the assets, but in certain instances where we've generally done very well. Mm-hmm. And so as a firm, one of the things that we are acutely focused on is really risk mitigation as a part of the investment strategy and the execution.
That's great, Brooke. I appreciate you going into all that detail. So to kind of summarize, from what I understand, you guys are these loans are about $2 to $20 million in commercial real estate.
Yep.
These are shorter duration loans, and this is kind of a more underserved market. Is that's all correct?
That's a very fair characterization. That's exactly right.
Yeah, and you mentioned you're funding the most senior portion of the capital stack, leaving the riskier dollars in reserve, essentially. Yeah. Okay,
that's right.
So you mentioned you're kind of talking about mitigation risk there.
Yeah. And I think it's important for the audience to understand why do people come to us? And they really, experienced sponsors come to us for really one of three simple reasons. Okay. They're either trying to rehabilitate, renovate, or convert an asset for its highest and best utility. There's generally a value add component to the project or the initiative that they're undertaking. But because there is a lack of liquidity and a scarcity of capital in the market, they're willing to pay a premium, right, in order to access that. Because generally speaking, whatever value add project that they're undertaking has a higher return on investment than the amount that they're paying as an interest. So there's a value arbitrage there.
Got it. How do I guess that kind of brings up a good question. How do people find you? How do you find people? So I should say, like, how do you find people that are looking to borrow money?
Yeah, so we've got our own. As a firm, we're a vertically integrated firm, so we've got our own origination team, and most of our originators, they have between 25 to 30 years of experience in the industry, right? So we generally do a lot of work with your tier one, tier two, commercial real estate mortgage brokers. So your CBREs of the world, your JLLs, your Cushman Wakefields. And so that's why, last year alone, we just got off a call earlier today. So year to date, we've seen $4 billion in top of the funnel deal flow. So why does that number even matter? Well, that just allows us to be very selective in the types of lending opportunities that we pursue and really the quality of the assets that we bring into our funds. But last year we saw an excess of 8.4 billion. Now, if we're going to be sincere and genuine in our time together, I'll be honest, 70% of that deal flow would never satisfy our institutional underwriting criteria. But you want to see the volume of the deal flow because it gives you a pulse of the market, kind of where the market is pricing and what's available in the market. So there's still inherent value to that particular information. And that's why we continue to collect it.
How does this compare to, maybe the recent past as well as like historically?
Yeah, it's actually picked up, in about 2023, what I can tell you is there was a bid-ask spread. And let me define that for a minute because I think it's important to understand. So the spread was what sponsors were willing to pay in order to access the capital versus what we were willing to lend at. And so that 300 basis points as the interest rate environment changed, it basically collapsed because people realized that, higher for longer was kind of the theme of what we were going to continue to experience. And, obviously we'll find out tomorrow with the Fed's meeting as to whether, and I know there's a lot of pressure, being applied by the administration for Jay Powell to, cut interest rates. And I think if you look at the applied Fed fund futures right now, it's pricing in 2 rate cuts for this year. But that bid-ask spread has essentially evaporated. So people are now willing to pay a premium. And I like to use a very simple analogy. Imagine if you had a 16-17%, interest rate on your mortgage. How long would you want to hold that note? You wouldn't want to hold it any longer than you needed to. So what we've actually seen from a trending perspective too is our weighted average life has come down from 21 months because remember, we're short duration transitional bridge lenders. That's come down from 21 months down to 16 months. And the reason for that is the cost of the capital, right? These borrowers want to get us taken out as quick as commercially reasonably possible because they don't want to carry the heavy debt burdening cost any longer than they need to, which is good for us from a time value of money standpoint. Because if I were to decompose the return profile, it's really 4 component pieces, right? The first is, we charge anywhere from 1 to 3 points of origination. And then you have the interest. It's generally 9 to 11% in interest, depending upon the risk profile and the type of transaction. And then there's anywhere between 1 to 10 points of back-end exit fees. And then the last component contributor from an attribution standpoint is the time value of money piece, right? Which we tend to get taken out, in many instances before maturity.
That's great, Brooke. Yeah, I guess from going back to what you talked about from a criteria, obviously you said 70% of the deal flow, it's not really institutional grade, essentially. What things are you looking at from a borrow profile lens or any red flags you learned to walk away from?
Yeah, that's a great question, Skyler. And I think probably the most frequent question we get is, what is the biggest risk? And we've got a series of kind of risk mitigation that's built in, to the execution of these. I say the biggest risk is the advancements and how sophisticated fraud has become. Fraud is one of those things, and we use a technology called Plaid that allows us to pull bank statements in a real-time environment. So as we're kind of going through and we're reconciling the sponsors or the borrowers, financials, if anything indicates a red flag, we're in a real-time operating environment. We can push the asset into default. That's probably the biggest thing we contend with because, I think the thing that helps us sleep well at night is that you are fully collateralized by a hard asset that carries a significant amount of intrinsic value, right? Even under the worst case scenarios, if you do have to take acquisition, you're generally going to do really well because our typical loan to stabilized value is right around 61%. So why is that important? Well, that just means that number one, there's a fairly substantial amount of equity that is sitting alongside our capital. But number two, it provides a high margin of safety against the permanent impairment of capital, right? So we think that's important just from an execution standpoint. But I want to make sure, does that get at the heart of your question?
Yeah. I heard real-term operating environment, which I think is interesting too, that you speak that from this space, which has traditionally been pretty manual and slow to move, right? From a due diligence perspective, which I find is interesting. What do you think from a deal to close, to origination to, contract. How long does that normally take you guys to kind of go through that process in the marketplace these days?
Yeah, it's typically 30 to 45 days. And that's one of the reasons that sponsors come to us is the speed of execution and the certainty of closure.
Yeah.
Generally whatever project they're undertaking has some element of time
Mhm.
sensitivity to it. And so again, that's one of the things that, we really position ourselves as being a partner, a lender of choice. And we've really refined all aspects and institutionalized all facets of the business. So, we can go through an institutional underwriting in, a 30-day time horizon.
That's great. I think the market has traditionally been way longer than that. So that's great to hear.
Yeah. You go through traditional financing sources like a bank, or it's going to take 120 days,
Yeah.
at a minimum.
Yeah.
Whereas, that's one of the,
Mhm.
that's one of the primary reasons that, people, come to us. But what's really been interesting is just how irrational the market is right now. And, I'll give you guys just a quick, case study, and we may have touched on this at some point. But there was an industrial complex in Melbourne, Florida, right? So the sponsor had, I don't know, 20 plus years of experience, and it's very simple. His business model is just to acquire these industrial complexes, to reposition the asset and just set it up for a strategic disposition or sale at some point over a 3 to 5 year time horizon. And so in this particular instance, when you look at the facts, there was no tenant in the facility. So as I'm sure you can imagine and the audience can appreciate, there's no bank, credit union, insurance company that's going to lend on a non-cash flowing asset. But this particular sponsor had a fully executed, fully enforceable lease agreement with Jeff Bezos' Blue Origin. And it's really simple. He needed the $10.2 million. Part of it was for the acquisition of the facility, and the balance of it was for some specifications required by Blue Origin before they took occupancy of the facility. So, we see a transaction like that. Number one, you've got a 10-year cash flowing asset. Number two, you got a high quality credit tenant, in Blue Origin. I mean, we'll underwrite those transactions all day. That's an ideal transaction for us, to bring into our funds.
Yeah, that's really interesting. Yeah. Going back into another question, just regarding, investors and RAs remain, very underallocated to private credit in general. What do you think that is? I mean, is it just a lack of education as kind of
It,
or what are some of the nuances there?
yeah, in this trend, and we've got a lot of independent RA investors that are invested in our fund. And there's one particularly here, not like the name of the firm unnamed, but it was his first time really investing in alternatives and private credit. And I think 2022 was a pretty revealing year, right? Because in 2022 we had a breakdown in cross asset class correlations between equity and fixed income. And you had a drawdown in excess of 10% in both the S&P and the Bloomberg Aggregate Bond Index. And diversification works until it doesn't work. And 2022 was pretty revealing year, right? And I think it was an eye-opening experience in that, you need, to have exposure to alternatives to help dampen the volatility and to provide a differentiated source of return. So you're not relying exclusively on equity beta and credit risk premiums. I mean, I think that's the advantage. So, part of it, I think, is just educational in nature, getting people comfortable with the space. Because part of what we do is we do a lot of educational webinars alongside the RAs because they're not as necessarily comfortable in discussing what we do as a business. But we do it as a resource, as an educational resource, so that their clients, have a little bit of more comfort around what we're doing, all the different levels of risk mitigation that's built in. And we look at it as more of kind of a strategic relationship and a strategic partnership and really just educating them into the space. But I think your point at the heart of it is, I think it's more of an educational thing. And, just a 60, 40, 70, 30 portfolio, yes, you have liquidity, but there are certain advantages to harvesting that illiquidity premium and having exposure to an asset class that can really help to dampen the volatility, within the construct of a total portfolio.
Yeah. Yeah.
Now with
Absolutely.
couple of different things I want to talk about here.
Sure.
Let's kind of talk about I guess actually let's I'll focus in on like what you guys are working on, and then we'll go more like broad scope because I want to hear your thoughts on just like market things like that. But Your average deal size about $2 to $20 million. You mentioned how do you guys you mentioned like people are going to be working on maybe like renovations, things like that for properties. These are focusing on like commercial properties, right?
That's right. It's all income producing commercial real estate assets. That's right. But let me touch on something for a second, Mike, because one of the things that you were talking about, I think it might be beneficial to talk about some of the institutional trends that we're hearing from some of the groups that we're naturally talking to, just to give you guys some anecdotes and to give the audience some kind of collective market insight. Because I think there's this overarching theme that if you believe that we could be entering a changing market environment marked by lower returns across traditional asset classes like equity and fixed income, then having exposure to alternatives, and specifically private credit, can be extremely accretive, right? Private credit, if you look at capital market assumptions and expectations and all the financial institutions publishing, whether it be JP Morgan, BlackRock, Goldman Sachs, et cetera, private credit is expected and forecasted to be one of the best performing asset classes over the next 10 years. And that's pretty consistent with what we're seeing. And a lot of that is because it's the income generation component. Now, what I can tell you is a lot of the groups that, particularly on the foundation and endowment side, what they've seen and experienced over the last 2 years is they haven't been receiving distributions from their private equity or their venture capital book, which has really put a lot of pressure on their asset allocation mix. Now, the expectation is that we're going to hit the inflection point this year, right? And distributions are going to start to normalize. But really, over the last 18 and 24 months, there haven't been any realizations or harvesting within private equity and venture capital. That study is actually supported by Bain Capital too. They actually released a publication, kind of showing their 2025 forecast and expectations. Now, one of the benefits of private credit is there's no J curve. With private equity, you have kind of the investment period followed by the harvesting period, right? Now, investment period could be anywhere from 1 to 3 years. You're harvesting, 3 to 7 years. It's actually been extended in duration because, again, the lack of these distributions and harvesting. But with private credit, you're cash flowing day one. There is no J curve effect with it. So there's a fairly significant advantage because you're accruing that interest and you're generating that income, effectively from the first day of the invested capital. But I will tell you, most of the institutional groups that we've been speaking to, are all seeking to add or increase their allocation to private credit because, again, of all the things that we've inherently just discussed, the cash flow, the optimization, how it improves the risk efficiency and just, the relative and absolute attractiveness of that sector of the market.
Yeah, agreed. And yeah, we've definitely had a handful of conversations around private credit, and we've heard from some people too. They think it's kind of a bubble in terms of what's happening in private credit. There's so much new money being allocated that way. What are your thoughts on the space from that perspective?
It is becoming an ever increasingly crowded space. I'll agree with that, and I think that's consistent with what we kind of touched on earlier. That turning on Bloomberg and seeing something about private credit every day.
Yeah,
I think it's important. You have to bifurcate and understand exactly where you are in kind of the private credit spectrum, right? Because something that is senior secured has a much lower risk profile than subordinated debt. In many of these private credit strategies, I think the most important question you can ask is how much embedded leverage is there within the strategy? Now, we've managed to generate our returns on an unlevered basis. Now, we have the ability to use leverage, but in this market environment, we didn't think it was judicious or prudent to do so. So as you guys are thinking about, and as the audience is talking to other kind of private credit related firms, one of the fundamental questions that you should think about and you should be asking is how much leverage, either at the transaction level, the fund level, there could be credit facilities. You need to understand exactly how that's being applied and to what extent it's being applied, because that dramatically changes the risk profile.
Yeah, those are really good points, Brooke. Yeah, that's very helpful for our audience to understand. I guess going back to even to kind of where you guys sit from a band in the private credit space, you mentioned you kind of tilt towards multifamily or commercial, which tends to be more resilient, right? What are the aspects of that you think about, and what should the investors know from a hidden risk perspective? What should they understand relative to where you guys are sitting?
Yeah. And so we have taken a kind of tactical overweight to multifamily housing, and the thesis is really embedded around this kind of core principle that, look, if we're going to be sincere in our time together, there's a shortage of housing in the U.S., right? And if you're going to be tactically overweight a sub asset class, we think being overweight, multifamily housing makes a lot of sense for a couple of different reasons. Number one, that sub asset class tends to exhibit more defensive characteristics and be more economically resilient. And we think, given where we are in the market cycle, that's just the best place to deploy and the most attractive place to deploy capital, just based on this, again, this current market environment that we're experiencing. Now, we'll do light industrial, we'll do some select retail if it's a grocery anchored tenant. What we do not do is ground up construction, and we do not do downtown central business district office because that sub asset class is just going through such a major transformation right now. I mean, you can't get a bid on a piece of office space in San Francisco, downtown LA, heck, downtown Atlanta. I was in a meeting the other day in Buckhead, and the group was, I don't know, I think they were on the 8th floor, and there were 8 office spaces in there, and there were only 3 offices occupied of the 8, and the rest of the floor was vacant. So, you really have to be intentional about how you're deploying capital and really understanding, the risk profile of the underlying asset. And we think that's just an important part.
Yeah. That's very interesting. Yeah. And then you're underwriting these loans, is it like 88 cents on the dollar, whatever it is, short duration, high visibility. What's the most understood aspect of short duration private credit? This is not just another commercial real estate credit story. It's just very unique in how you guys are operating here, it sounds like.
Yeah, I think, it is probably part of what we enjoy doing is just educating people on how to think about the space. Because again, operating in that kind of lower lending sector of the market it's extremely inefficient. But again, one of the benefits is that you are competing with your Blackstones. They're not going to underwrite a $7 million loan, right? Yeah. And so that's what we're happy to do because you can harvest, again, 200 to 300 basis points of incremental yield, for the benefit of the investors. Now, we don't think the market environment is going to continue to shift. I know the Fed's got a meeting tomorrow, which we've kind of touched on earlier, and the market's pricing in some rate expectations and cuts. One of the things that we do from a structuring standpoint is we are SOFR-based pricing. Okay, so let's, for the benefit of the audience, let me just explain the concept a little bit. So SOFR tends to exhibit a lot less volatility than the Treasury market. But at the time of the closing, one of the things that we do from a structuring perspective is we will lock in the rate. Okay, so that serves effectively as an interest rate hedge. If rates grind lower or SOFR moves lower, then we've created a floor effectively with the rate. However, it's dynamically floating to the upside. So every month, if SOFR were to move higher, then we've got the ability to effectively reprice, capturing the upside capture with that. So it's very beneficial and advantageous for the investors. The borrowers don't like that structure because obviously it can be costly in a hyperinflationary environment. But we did that in order to immunize and to really immunize the interest rate risk at the end of the day.
Yeah. That's interesting. That's actually really interesting. And I guess, these loans are short enough duration where as a borrower, it's not, hey, I'm missing out on 100 basis points.
No. And you don't see SOFR move that radically either. But I think the other thing, that I think is worth touching on is kind of the structuring aspect of it. Because, so when you think about a $10 million loan, okay, and this is, maybe for the benefit of the audience, we take the first $5 million. That puts us in the senior position, right? Top of the capital stack. Nobody in front of us, nobody behind us. What do we do with the other $5 million? Well, it's very simple. We hold, maintain, and control it on our balance sheet for cash, interest, and construction renovation reserves. Now, what do we do with it? We merely park it in an overnight money market fund yielding 4.5%, 4 3/4 to generate some incremental yield. However, the borrower is paying day one as if we had fully deployed the $10 million, although they only hold and control $5 million of it. It's referred to as what's called Dutch interest. It's extremely accretive from a time value of money standpoint. And, borrowers tend not to like it, but, look, this is a market environment where if you have the cash and liquidity on your balance sheet, you can basically harvest and collect a very attractive premium.
Yeah. It goes back to what we talked about with risk mitigation, making sure, things.
That's right.
It's interesting. So somebody wants to take out a, $10 million loan with you guys, you're giving them the 5 up front. And then do they have an opportunity to borrow the other 5?
They do.
Or is that kind of...
As the construction and renovation work is being completed, those proceeds are drawn down over time. And really, I'll give you a directional number. On average, we only deploy about 88 cents on the dollar a total deployment. So again, you're never fully deployed, never fully funded at any point in the process.
Yeah, very interesting.
Yeah.
Well, another question that came up in my head was when it comes to, like you mentioned, like the Black Rocks, the Apollos, they're not involved in this space. What scares them away from this space? Or I assume maybe it's size. Are they just looking to make bigger loans for larger construction projects?
Yeah, quite honestly, and even banks to a larger degree, they don't want to go through an institutional underwriting for a $6.5, $7 million loan. It's just not
Right.
sizable enough and not profitable enough to go through, and rinse and repeat, go through that process in multiple iterations. So that's what helps contribute to the inefficiencies of that sector of the market. But that's where we specialize, and that's where we think there's a tremendous amount of value to be harvested and realized is in that sector. I like to use a very simple analogy for the benefit of the audience. You think about it like an equity strategy. You got large cap, mid cap, small cap. We're kind of down here in the small cap space in the private credit sector of the market. But what I can tell you is, as you move up to larger capital tranches, so call it 100 million to 250 million to 500 million, where most of those mega players are operating, there's a lot more pricing compression. We tend not to experience the same level of pricing compression again because of the lack of national competition in that space.
Yeah. Well, you kind of effectively created a moat around what you guys are doing. And to your point, getting a $7 million loan, waiting 120 days plus to contract from that loan, doesn't
Yeah.
really make sense, right?
It's just
So,
Skyler, it's just such an irrational market right now. And, maybe at some point it normalizes, but we just don't envision that, for the foreseeable future. It's been this way for the last 2 to 3 years, and we think it's going to kind of continue to persist. And that's just, I think, the new market era that we're in. Thematically, I think if you do believe again that we may be entering, a changing market regime, and we can debate and argue the merits of that, whether you look at equity valuations, or you look at the volatility of interest rates. I think having exposure to alternatives, and some private credit can be, again, really accretive given the income orientation of the strategy,
mhm. Yeah.
regardless of who you're invested with. Again, though, I think it goes to the core of just understanding the risk profile and the amount, the degree, and the level of leverage that's being used, whether it's at the transactional fund level, credit facilities. There's a lot of different ways that they can technically be applied.
Yeah, definitely. I wanted to ask you too, just by obviously you have a very, institutional, large scale investing background, coming into to where you're at today at Oak Real Estate Partners. What has changed your thinking about what either success looks like over time, or maybe just nuances and how you thought about the market's been played, to this point, and how you've adapted, and maybe you've seen challenges and what's happening, over time, what's been different or the same, or whatever you think from that
Yeah.
perspective.
So, we generally employ a little bit of a different approach, because look, if we're going to be sincere, anybody can go in and pitch a strategy. Anybody can go in and pitch an offering or a product or whatever you want to call it. We take more of a consultative approach, and really taking the time to understand whether it's an RAA, a foundation, an endowment, because private credit has a broad application and broad utility. It can be used as a diversifying strategy. It can be used as a more optimal alternative to, traditional fixed income. It can be used as just private credit, private debt. But really taking the time to understand what each of these groups is trying to solve for from a portfolio optimization standpoint. Is it risk, return, yield, diversification? Because of that application and that broad application, it can fit within the construct of a mandate in several different ways. But you don't know how to really work and collaborate and to partner with these groups until you understand exactly where their pain points are and what they're trying to solve for from an investment optimization standpoint. So it's really much more of a collaborative and consultative approach. And I enjoy that. You learn something new because everybody tends to look at private credit through a little bit of a different lens. I can say we've not had one conversation that I would say mirrors, mimics, or replicates another. Every conversation is a little bit unique in its own regard, which is a good thing. But
Yeah.
people are trying to solve for something inherently different. And I think it's just taking the time until you understand what that is. You can never really position yourself to talk about how exposure to a strategy like this can be instrumental until you understand what their pain points are. So we
Mhm.
take a very much a very different approach to it. And I think that's been, very attributable to the success that we've had, in working with a lot of different groups. Because again, it's not about going in and just, giving a 30,000 pitch on a strategy. That's not who we are. It's really, again, understanding where they're trying, where the portfolio, how it's being allocated today, where they would like to see the allocation go, and how can you partner with them in getting them to the place that they want to be.
Yeah. And to that point, what's been the investor appetite? Or is this something investors are excited to jump into?
It is.
Any hesitations?
No, I'll give you a directional number, but I would say, probably 80% of the groups that we're talking to, and there's 400 plus groups, so I mean, the list is long and distinguished, are looking to increase an allocation to private credit, for all the various reasons we touched on, the cash flowing nature, the dampen the volatility, if you believe we're entering into a changing market regime. So there has been a wide appetite, for exposure to the asset class. Again, I think it's really a bifurcation of understanding where you are in the capital stack, the principles and the philosophy around risk mitigation. That's an important concept, to share with investors. But I would say, uniformly and thematically, the trends have all been, people are looking or seeking to increase their allocation just to broadly alternatives, with the idea and the notion that, traditional asset classes, may be experiencing some headwinds in the coming quarters and months. Because I mean, think about the year that we've experienced, right? I mean, we came out of the gate strong. We had a fairly substantial drawdown in the equity market. And now we've had kind of a risk reversal, kind of getting us back to where we were. There's just so much uncertainty, across kind of traditional asset classes. And I think, that's the thing that I think people are naturally trying to grapple with. Whereas, when you have exposure to a hard asset, an income producing hard asset, again, that has a fairly significant amount of intrinsic value to it, you can sleep well at night. And I think that's one of the things that, helps our investors sleep well.
Yeah, definitely. That's really interesting. I have another question related to more just kind of the industry in general. And I always get these questions too on my side, so I figured I'd ask, given your background. From younger generation, people coming into the space, they see private credit as a great opportunity. Some people say it's a bubble. Some people say, a lot of things, right? But from your lens where you sit, you have a unique perspective. What would you say to someone looking to get into private credit in the industry that is maybe relatively new and looking for opportunity, whether it be to just get into a firm like you did?
Yeah, it's a very attractive, whether you're looking at it on a relative or absolute basis, it's a very attractive asset class. And I don't think that naturally, kind of significantly or substantially changes on a go forward basis. I think the advice that I would render is, if you're looking to get into this space, again, you have to understand the idea that not all private credit is created the same. Understanding the risk profile, the return dimensions, what's contributing to that return, doing a little bit of attribution. Because again, people apply private credit in a variety of ways. And, we did a case study that we shared with a couple of groups, and, the case study kind of talked about and more specifically addressed private credit. Now, I think the opportunity set is going to continue to persist. I guess the guidance that I would issue is, to be patient, to take the time, understand the risk profile of whatever strategy it is that you're either looking at, you're underwriting, or even the firm that you're looking to join. We were pretty fortunate in the sense that, we just had a strategic hire, a gentleman by the name of Matt Webster. Matt ran all of commercial real estate finance for HSBC, right? So, I mean, he had, tens, if not 100 billion of, commercial real estate exposure they had responsibility for and overseeing on the balance sheet. So, Matt brings a tremendous amount of transactional experience to the firm. And, we're very pleased. Matt's going to be a tremendous asset and resource to us. And I think that's what we're really excited about and we're passionate about, is really just sharing the opportunities and what we're seeing, because again, it's the right team with the right level of expertise, the right pedigree, and really what I believe is the right asset class and sub-asset class. And I think that's an important part of it.
Yeah, I think that's great. And I also saw on your guys' website, you have the Social Impact Partnership Program, SIP. Can you tell us a little bit about that?
Yeah, we've got a lot of different things that we are involved with. That's one of many strategic initiatives. But yeah, It's really one of the things that I think sits at the core of who we are as a firm and the fabric of our DNA. But, and I'll use, a couple of the transactions as an example. When we have the opportunity, we want to do things that have a positive societal impact. Now let's bifurcate that for a minute, because we are not an ESG shop, right? That's not who we are. But there are a couple of transactions where we feel like that, if it's accretive to the investors, then it's accretive to the fund, and it has a positive societal impact. We want to be involved with that. Like there's a couple out of DC, okay, and it's very simple. It's a part of what's called and referred to as the DC Housing Voucher Program, okay. Mm-hmm. It's not Section 8 housing, but it is classified as, opportunity zones. And what these sponsors are doing is they're converting 1 and 2 bedrooms into 2 to 3 bedrooms in order to make it more spacious and accommodative for families, right? Mm-hmm. And so it's all backstopped by HUD, right? And these sponsors are basically paid a very attractive premium to go through the conversion of these assets. I mean, there are some, I think, 20,000 families on the waiting list for these units. Now, being involved with a transaction like that, where you're providing affordable living to people who don't have the financial means and the resources, look, if we believe, number one, the criteria is very important. It has to be accretive to the fund and to our investors. That's always going to be the first criteria. But if it does have a positive societal impact, we'd love to be a part of a transaction like that. We think that's an important part of our DNA, an important part of our philosophy, as a firm. But I think that's a pretty good illustration. And we've done, 8, 9, 10, 11 of those types of transactions. That's kind of who we are. And it's not.
Yeah, that's really great.
Yeah,
great,
most of them have been in
you guys have
area,
there.
But we do them. Different districts, different jurisdictions have, they all have voucher programs to varying degrees, and so we've done several of those types of transactions for sure.
Yeah. Very cool. Yeah, it sounds great. It's something it's good for the investor. It's good for, you guys. There's money being made, and then it's also, helps out folks in society. So yeah, it's always great. Awesome. Brook, anything you want to talk about that we haven't talked about yet? Anything on your mind that you want to cover?
No, Mike, I think we've covered a wide array of topics. Look, what I'll offer is, I'm happy to be a resource. If anybody who's listening to the podcast, if they're looking for market intelligence or just collective insights, I'm happy to make myself available. We enjoy kind of sharing the information and making it educational for people, even if they have a question about a strategy they're invested in, from a private credit standpoint. We like that educational aspect and feature of what we do. That's what I enjoy. I think that's what drives me and what keeps me passionate about the work that we do, not to mention the types of returns we're able to generate, but that's beside the point. So yeah, I'll just offer that out for the benefit of the audience. If there's ever any questions or, anything inquiries that may readily come to mind, I'm happy to make myself available.
Yeah, absolutely.
Awesome.
Well, Brook, this has been a lot of fun. Where can people go to connect with you and learn more about Oak Real Estate Partners?
Yes. So we do have a website, oakrealestatepartners.com. And the profiles are out there. Obviously, my email address is bscardina@oakrepartners.com. I am happy to receive any correspondence or emails or inquiries through that channel. So that's probably the best way given the amount of travel that we do, that's probably the best way to get in contact with me. Otherwise, we're traveling, fairly extensively. So, I'll just offer that out.
That's great. Yeah. Again, this has been a great conversation, Brook, and we'll make sure to include all that in the show notes. And thanks for educating our audience.